One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. Hello, my name is Alex Mason and I am your host. And I want to talk to you today briefly about the difference between a company collecting cash and recording revenue. This is a really important accounting concept that at first for me was a little difficult to understand, but it's really not that bad. And so I want to explain to you how it works. So I used to think that when a company made money, as in made sales, that was basically it in terms of accounting for the amount of money the company made in terms of its top line. Because remember, we have revenue, there's expenses, and then profit after that, if we're thinking about this from an income statement perspective. But that doesn't tell the whole story. And we've been walking through some of these examples in terms of the three financial statements. We also have the cash flow statement. The cash flow statement tells us how much money is moving into and out of the business over time, whereas the income statement tells us the profit and loss of a business over time. Now, cash flow and profit are not the same thing, and this is really the crux of the matter. So when a company collects cash, let's say that you and I own a lemonade stand and we're standing on the corner and it's a cash-based business. We're selling lemonade and people are paying cash and then they're getting their lemonade right away. Now, in that type of situation, we could use what's called a cash-based accounting system. So very simply, the amount of money that comes into and out of our business is purely based on the cash that we receive and the cash that we disperse or that we pay to someone else, like for material for our sugar and our lemons and things like that. So that's a cash-based system. If someone decided to buy a bunch of lemonade from us and they said, look, I can't pay you right now, but within 30 days, I'll give you all the money. But we would give them all the lemonade up front. There's this timing difference between when a company gets the cash and when it actually renders the good or the service. And so that's where we want to use an accrual-based system. This is the system that all major companies use because of these timing differences between cash being received and services being performed. And this is a very simple example, and there's a lot more nuances to it. But fundamentally, that's what's going on here, is in accrual-based accounting systems, we are accounting for credit, essentially. That's why you have different accounts on the balance sheet, like accounts payable or accounts receivable, for example. They're things that are either owed or owed to us as a company. So accounts payable, we believe that we actually owe someone, let's say a vendor, money within a certain period of time. Accounts receivable, a customer may owe us money over a certain period of time. And so we record those things as assets and liabilities to account for that. So when revenue is generated is when the actual good or service was rendered to the customer. So you can imagine for a subscription-based business, we talked about Spotify the other day on an episode, if you pay Spotify, they receive that cash like right now. However, they don't necessarily get to count that as revenue until the service or product was actually rendered to you, until they actually give you what you paid for. And there may be a time difference between that. So the same thing for other subscription-based businesses like a Netflix or something like that. In that case, there's something called deferred revenue. And then that's a liability on the company's balance sheet because they haven't actually recognized the revenue yet, but over time that will become revenue, even though the cash has already been received. So you have this distinction between cash generation and profitability, and it's really important to understand that difference because that is what underlies the main differences between an income statement and a cash flow statement. That's what I got for you today here on Investment Banking Insights. My name is Alex Mason. I hope you're doing amazing, having an incredible day, and I will see you on the next one. All right, bye.